Morning, Coach.
Good morning, Luke. How are you this morning?
I'm fine, thanks, and you?
I'm fine. How is Havoroni?
Havoroni is fine, and how's Lusaka? Are you back in Lusaka?
No, I'm not. Actually, I'll be checking out anytime soon. So I have to, first I'll go to the workroom, do a bit of some works with some guys, then maybe around 2 or 3, I start off going to Lusaka. Just that the road is quite bad, but I'll be moving in quite slowly. Yeah. Victor. Oh, is Victor there? I thought he was there.
No, he was there and then he dropped off. I'm not sure what happened. I hope he didn't get a power cut.
I hope so. I hope so. Zimbabwe power cuts are quite high, huh?
Yeah, especially in winter. I don't know, but they had a long period without the load shedding, and I think maybe it's because of the winter, or maybe we could say there's more production now.
Victor, good morning.
Morning, Coach. How are you?
I'm fine. How is Harare, a home of crocodile?
Harare is well. Good.
Okay. That's very good.
Sorry, my mic was I was getting in and I could hear you and you could not hear me because my mic was not working.
Okay, at least you fixed it. I'm glad you have.
Yeah, I'm now good.
So we'll try to move a bit faster, though the program is a bit long on IFRS16. We did part 1. Now we'll be going to part 2. I just want to, once we are done, then I go to the workroom at the divisional office, do a bit of some work with some guys. Then maybe around 3, I start off going to Lusaka. The only worry is that the road is extremely bad. They are no longer potholes, they are boreholes. Yeah. I guess it is a similar story across Africa. Maybe selected places, because even in South Africa, some areas the roads are not good.
Yeah.
Yeah, the roads, it's a terrible situation. The issue of roads in Zimbabwe, we have given up.
And you see, the problem that we have always had is we don't invest in maintenance. And that's a very huge problem. You will never see a huge budget on maintenance of these particular infrastructures.
Yeah.
Okay, we then now go to operating lease. Part 1, we looked at quite a number of things. We did a bit of some exercises. I think there were about four problems that we looked at. Now, today we go to operating lease. And on operating lease is that the income receipts will be recognized as through profit or loss and using a straight line basis. And depreciation on the asset continues over its useful life. But remember what we looked at last time. I think we did actually explain some few things as a team. What we said, if say, for example, the lease life is 5 years and depreciation for this particular economic for the asset is 6 years, then you go for 5 years. You always go for the lower of the two. This question is almost similar to what we looked at, but under this, we are looking at it under operating leases, sorry. Banda leases out a machine to Munyama under a 4-year operating lease. The terms of the lease are that the annual lease rentals are $2,000 payable in arrears. As an incentive, Banda grants Munyama a rent-free period in the first year. Explain how both banda would account for the lease in the financial year. Obviously, we know that there will be a certain amount that will be released and another amount will be actually accrued. So you have, say, 1,500 from this, which will be accrued, because how do you compute this 1,500? We did look at how it can be computed. We said it's 2,000 times 3 divided by 4, because we know that there's 1 month which has been given, 1 month, is it 1 month or 1 year? Which a year basically that has actually been given to you. It's more of an incentive for free. So you need now to spread that 6,000 equal 4 years. And this is So ideally, this is what is going to happen in the LEASES accounting. The income of 1,500 would be recognized through profit or loss for each of the 4-year lease. At the end of year 1, accrued income of 1,500 would be recognized on the statement of financial position, of which obviously 500 would be released over the remaining 3 years of the lease. We looked at this, but then we are looking at it from the angle of the leaser. I've duplicated a lot of things. This is what I'm saying. Yeah. So finance lease accounting. 1, de-recognize an asset and record the receivable. Record the receivable at net investment in the lease. 2, record finance lease receipts as a reduction in the receivable. 3, record interest on the receivable. So you understand this concept when you look at one of the examples. Like for the gross investment, it is all the lease payments, plus if there's any residue value, you add that residue value, it gives you the gross investment. But for the net investment in the lease, it is the gross investment in the lease, and you discount it at and apply it at a given rate. Let me do this. Sometimes explanations are better computed. We can come up with some numbers of some kind. Let me give this example a look. Let's say there's a building that you have that has been leased to you. Maybe let me say building here. Don't mind my handwriting. That you'll be paying 20,000 pola annual. 20,000 pola annual payment. Please get this concept right. The lease period is 5 years. And you'll be paying on the first day of the year. So let's assume that it's 1st January. So in year 1, then you're told that the residue value is say 1,000. This is the residue value. Residue value is like, is it a proxy? It's a proxy of scrap value, actually. And you should always regard it as an income or as a cash inflow. So this is what we are going to do in getting the gross investment. It will be, if it's for 5 years, it is 20,000 times 5, which gives us 100,000. 100,000 plus 1,000, it will be 101. This will be the gross investment. But then we have been told that the discount rate or implicit rate is 5%. Okay. So our work would be to compute the net investment lease. Net investment in the lease, sorry. So you have year one, which is 20,000. Which is basically 0, year 0. It's now, meaning that the discount factor would be 1 and you have the 20,000 here. In 1, you have 20,000. Whatever discount rate that you get, which is 1 over 1.05. What's the rate? 1 over 1.05. Okay, whatever rate you get here, the discount rate, it's just an example. You go to year 2, 20,000. You put your actual discount rates. I want you to get the net investment. You have your discount rate there. Year 3, which is 20,000 times the discount rate. Year 4, 20,000 times the discount rate. In year 5, you have the residual value of 1,000 times the discount rate. Whatever value you're going to get as present value, that value will be regarded as an investment in the lease. Hello, does it make sense?
So, hi, Coach.
Hi, look.
So the product of all from year 1 to year 5, after applying the discount rate, is what you consider as the present value.
It's what you consider as the net investment in the lease. It's basically the present value.
Okay.
Of your, it's the present value of your gross investment, in short.
Okay.
Victor, is it okay?
Yeah, it's okay.
Thank you. So in short, you have this unguaranteed residual value, which will be given in the exam, or the examiner, you'll be given, or you have to compute it. It's a duplicate. This one. So you have this, and I would want you to look at this question, but I'll guide you, however, so that as you're looking at it, I'm going to have just a meal quickly under 5 minutes. It reads, Cherry leases out an item of property. Sherry leases out an item of property, plant, and equipment under a 5-year lease. The lease commenced on 1st January 2015, and the rate implicit in the lease is 4%. The annual lease rentals of $5,000 are paid at the start of the period. Sherry estimates that the estimated residual value of the item of property, plant, and equipment is $2,000, and the guaranteed residual value is $1,600. So here you want to find the unguaranteed. That's the whole issue. So the unguaranteed Victor's having problems with the network. So the unguaranteed residual value will be the estimated residual value, which is the 2,000, minus the guaranteed residual value of 1,600. So what you're going to get would be 400, which is unguaranteed residual value. This unguaranteed residual value is going to help you to get your gross investment. So your gross investment is the rentals plus the unguaranteed residual value. So I would want you to look at this question so that you get the net investment. You get the net investment, meaning that you need to find your present values. From year 0, obviously you have a 5,000, year 1, 5,000, up to I think year 4, 5,000, then year 5, obviously you're going to have a 400. Then from there, you are going to discount, you bring in your discount factors and get your gross your net investment. Just about 5 minutes.
In the 5 years. So we have.
How much have you found, guys? How much have you found?
For the 5 years.
How much have you found as as net income?
That's 384. I found 24,423.07.
Okay, what? I hope you did the correct thing. This will be your net investment in the lease.
23.
23. So where did you miss it here?
How do we calculate the
discount?
The discount rate. Let me show you.
Yeah.
First, in year 0, it's basically it's 1, so you leave it as 1. Then here it will be 1 divided by 1.04. So to give you this number.
Yeah, that one is correct.
Then in here now it will be 0.962 divided by 1.04.
Okay.
Then on this one here, Mukayoka, on this one here, it will be 0.925 divided by 1.04. Just like that, just like that.
Okay.
Mm-hmm.
Okay now.
Yeah.
Yeah.
Mm-hmm. I know in the exam they'll give you those tables, but me, I don't follow those tables. I'll just use my calculator because I used to find it much faster. So whatever number I get, I cascade it divided by 1.04 or 1.1, depending on the discount factor.
I think we missed it because of the discount factor calculation.
Oh,
We used
okay.
the same discount factor that we had calculated in year one. That's the discount factor that we used.
Oh, okay. That was a major error, but I hope now you get it.
Yeah, I get it.
Muka, good morning.
Hi, good morning.
Okay, so now we have looked at the first scenario where you as a business, you are actually leasing a property. But now there's also what they call sale and leaseback. And it's done in for so many reasons, for financing, basically quite a number of financing reasons that would motivate an organization to lease, to sell and lease back. So you sell an equipment, you sell an asset, for example, to Muka. Muka buys that asset, but it's not Muka who's going to use it. It is still you who's going to use it. You lease it back. And I used to see it so many times when I was young in Livingstone, where you find a situation where a retiree has a very beautiful house with a 7 quarter, what we used to call them as 7 quarters. Maybe this time they're called guest wings, but they were designed for 7s. So we used to call them 7 quarters. I don't know in Zimbabwe what they are called. So this retiree with time, his money depletes. He has no other option. So the only option is to sell the house and rent a 7th quarter. So in short, what you have done, you have just sold and leased back. It's a sale and lease back. It's just that maybe you have gone into a 7th quarter. You have demoted yourself. Some will not even go into the 7th quarter. They'll remain in that house. They believe that since now they have so much money, they can still be paying rentals. It's one way of financing. I don't know if you get the logic why people do such things. It looks crazy, but it's one of the financing methods. They're saying, no, I'd rather sell this house at 200,000 pula and start paying 2,000 or 3,000 pula every month. So what I'm doing, you have just, it's a sale and lease back, but just given you a bit of liquidity that if you have a grand plan, you can use this financing, you can use that capital as a capital injection into that particular grand plan and generate more wealth, generate more value for yourself. But most of the time it doesn't work like that. The fact that you have sold and you have gone back into the house, it means that you didn't have good plans, maybe. Hello?
Yes, coach, we hear you.
So it's very common with retirees, but know why companies do that. It's just for financing reasons or purposes. Because they'll get a lump sum, then they start now paying leases on an annual basis or monthly basis. So the companies are required to account for the transfer contract and the lease applying IFRS16. However, considerations first given to whether the initial sale of the transfer asset is a performance obligation under IFRS 15. and we will need to do IFRS 15 after IFRS16. So we need to actually check if the performance obligation was met, or if conditions under IFRS 15 were met, which then recognizes that this is indeed a sale. So if the transfer of the asset is not a sale, then the following rules will apply if it is not a sale. So the seller or the lessee, the one who purportedly has sold, but there are the problems that it hasn't been recognized as a sale under IFRS 16. It means that that seller will continue recognizing the asset because under IFRS 15, the performance obligation hasn't been met. Then whatever amount that he got from the buyer, the fact that it hasn't been recognized as a sale, then it means that amount will be recognized as what? As a financial liability. Maybe it was just a loan. That's what the crafters of this particular standard were thinking. For the buyer, the fact that you haven't recognized that there was a sale or whatever transaction you made did not meet IFRS 15 conditions, there was no performance obligation whatsoever, then do not recognize the asset. You who has actually bought it, do not recognize the asset. But recognize a financial asset, the proceeds, recognize them. That this is just an asset that you have gotten. The other stakeholder, who is in this case the seller, who should actually be the lessee, is recognizing it as a liability. But if the transfer of the asset has met all conditions under IFRS 15, then it means that the seller, who then now becomes the lessee because has sold and leased it back, should be able to recognize in the first place, to derecognize the asset. The buyer should recognize the purchase of the asset. They recognize the asset and then recognize the sale at fair value. Then because then now it has been leased back, recognize the lease liability, which is basically the present value of the lease rentals, which is just the net investment. And we are now competent enough to do the computations on net investment. For the buyer, apply LESSOR accounting because then a LESSOR. For the seller, recognize a right of use asset because that asset is not yours. But then now you have full control of the asset. You are expected to enjoy future economic benefits from that particular asset. That identify the asset. You have control. So recognize a right of use asset as a proportion of the previous carrying value of underlying asset. Let me explain this. We'll look at the numbers where the carrying amount will determine the carrying amount will actually determine what should be recognized as a right of use. We'll look at one of the questions and do that. It's just basically the basically a split. So you don't recognize everything, just recognize the right of use asset as a proportion of the previous carrying amount. Okay, we'll look at that. Then end difference will go to gain or loss on rights transferred to the buyer. For the buyer or lessor, recognize purchase of the asset and apply lessor accounting. So here it reads, this is just on example 7, sale and leaseback. Apple required funds to finance a new ambitious rebranding exercise. Its only possible way of raising finance is through the sale and leaseback of its head office for a period of 10 years. The lease payment of $1 million are to be made at the end of the lease period. The current fair value of the building is 10 million, and the carrying value is $8.4 million. The interest rate implicit in the lease is $5 million. Advise Apple on how to account for the sale and leaseback in its financial statements if the office building were to be sold at a fair value of 10 million. One, on performance obligations are not satisfied, or two, performance obligations are satisfied. So we have the first thing that we'll have to do, we'll need to find the present value for these numbers, for this number, for 10 years at 5%. So let me go to Excel. We deal with this part. Just do this, sorry. You go into your PV tables, find on annuity, which would be a number like this. So this is a number that you're going to use. So you say $1 million. So the present value would be this 1 million times the annuity, 7 million, which gives you the 7.7. But remember, you have this will be your right of use at 10 million. So we'll say you have this amount, but the total is 10 million here. Remember the question? So the transfer would be this 10. The office staff started calling. Hello, yes, Daddy. But in the other side, ning open sa kopre from lipat, mayambako. Out, auto location. Sorry about that. Minus this. But all you are trying to do here the aim is to find the percentage of this. So meaning that you have this number and you see what we are saying the other side there. So you want these percentages. So the carrying amount, because that would be your right of use. Your carrying amount of, is it 8.4? $8.4 million. This is why they were talking about the proportionate. So the proportionate would be, you get that 77 point whatever times that. Then what would be transferred the other side would be this times 8.4. 1 point. So remember these numbers as we go back to the slides. I'm just rush. So I said the current fair value of the building is 10 million and the current value is 8.4 million. The interest rate implicit in the lease is 5%. Advise Apple on how to account for the sale and leaseback in its financial statement. If the office building were to be sold at a fair value of 10 million and performance obligations are not satisfied, so meaning there's no sale, and we have looked at what it is if there's no sale. Because if there's no sale, then do not recognize these assets. Or you can recognize it as a liability. And the buyer should recognize it, obviously, as a financial asset. So this is given. Continue to recognize the asset at 8.4 million, you as a buyer, and depreciate it because it's still your asset. So whatever money you got, recognize it as a liability, as a financial liability, because of that transfer process of 10 million which you received. For the lessor, do not recognize the asset because in short, you haven't actually, you do not own that. That is not your asset. So do not recognize the asset as it has not been sold to you. But if there's any money that you got, or if there's any money, if there's what you, so they regard that as a financial asset. That transfer proceeds of 10 million. For the sale, obviously, when you sell something, you expect to receive cash. That cash that you have received is not yours, it is a liability. But if the transfer of the asset has satisfied all the conditions under IFRS 15, then what should you do? That asset that you sold, it's true you sold it. So do you recognize the asset at the carrying amount of 8.4 million? Recognize the lease liability at present value of lease rentals, which is the $7.7 million. Recognize the right of use asset as a proportionate of the previous carrying amount, which is about 6 point something, because to be 8.4 times 7%, somewhere there. So recognize that. If there's any gain or loss on the rights transfer, that the gain and loss, it will be a balancing figure. For the lessor, recognize purchase of the asset at 10 million, fair value equals proceeds. Apply lessor accounting. Lessor accounting. This is how it's going to work. So let me just explain on this. I know time isn't with us. So for the seller, remember that Muka, remember that he has received or she has received a $10 million, right? So that $10 million is in his or her bank account. So debit the bank, that's $10 million. The right of use, this 6 point something, is coming from 77, which I had already computed, guys, 0.21735%. Oh, sorry, percent times 8.4 million. Which gives you this amount. The lease liability, it is the $1 million, which we had already computed, times the annuity of 7.721, which we had already computed in Excel, which gives you this. That's the lease liability. Because all you are doing here, trying to compute the gross investment of those 1 million, for which are 10, which gives you 10 million, times the discount, the annuity. So you get your present value, which is this amount here. But because you are derecognizing the asset, since you have sold, you are derecognizing your asset. You are going to derecognize your asset at the carrying amount. So whatever difference, as long as this side, it's a gain. If it was this side, it was going to be a loss. That would be the double entry. I did actually show you how to compute these things. This, I showed you in Excel how we compute this part. Now, there's an issue here. Suppose the proceeds, they are less than the fair value. If they are less than the fair value, regard it as a prepayment. If they are more than the fair value, regard it as an extra financing injection, capital injection. So I'm saying, note if the proceeds are less than the fair value of the asset or the lease payments are less than the market rental, the following adjustment to sales proceeds apply. Any below market terms should be accounted for as a prepayment. You know the fair value of this particular asset is 10 million. If you sell it at 9 million, you have a $1 million, which should be regarded as a prepayment in your double entry, meaning that it's going to sit on the first half of the balance sheet, which is assets. But then, if the fair value is 10 million, for example, and the proceeds, you have, for some reason, you have done a good job. You sell at 11 million and you get those proceeds. The 1 million should be regarded as an additional financing. Interesting. So the same question with just different scenarios down there. Apple required funds to finance a new ambitious rebranding exercise. Its only possible way of raising finance through the sale and leaseback of its head office building for a period of 10 years. The lease payments of $1 million are to be made at the end of the lease period. The current fair value of the building is 10 million, and the carrying value is 8.4 million. The interest rate implicit in the lease is 5%. Advise Apple on how to account for the sale and leaseback in its financial statements if the performance obligations are satisfied and the building sold for the following one, $9 million, two, or $11 million. So if it's $9 million, you expect a prepayment. So on the debit side, we are going to have a prepayment of 1 million. If it's 11 million, consider it as financing. And anything to do with financing, you'll see it on the credit side. So this is the first scenario. So you have a 9 million, which is coming as bank. You have a prepayment of 1 million. So that at any given time, it gives you this 10 million thing. And you have right of use, which we know how to compute, which is the carrying amount times the proportionate percentage. In this case, to 77.21%. Then on the credit side, you have the liability, this liability, you have the building because you are recognizing it, and you have a gain. For the second scenario, the 1,000 will be this side, the 1 million will be this side for the second scenario. Will be this side because it will be financing. So it will be on the credit side. So this is what would happen. So you have your bank, which is 11 million. Rights of use, which is 6 million. Then you have the lease liability. Your lease liability has increased, remember, has increased by 1 million because that is part of your financing. So you have that 1 million plus the 7.72 million, taking you to 8.721. Then you have a building here and your gain. For now, that is the end of IFRS 16. I hope I did justice, but I'll hear from you as you do your checkout. Tomorrow afternoon, we can look at IS 19. So the time for this is the only time that you have.
Personally, I think on sell and leaseback, that's where I the calculations, too many calculations there. If you could do us a favor, send the recording now so that I can continue.
Okay.
So that I get the concept.
Okay, not a problem. I will.
Yeah.
Okay, Luke.
Thank you, Coach. Yeah, I think I would need more practice on the last part of IS 16. If you could just give us maybe 2 class examples that we can work on, or we can just look at past exam papers. But and like Victor said, maybe send us the slide and the recording as well.
Okay. Muka.
Thank you very much. Yeah, I think for me also will be just to go through the recording and maybe find some more exam questions that we could go through, just to be able to now to align with the material, the explanations and how the questions come in the exam, and then we align ourselves.
Okay, thank you so much. So what I'll do, and I promise this, yes, I'm going to send the recording and the presentation. When I'm in Osaka, I'll come up with different scenarios, do short videos, maybe under 10 minutes on the LEASEBACK with different scenarios. So each scenario, I do a video and post it. Each scenario, I do a video and post it. It's like step-by-step manual. So I promise I'll do that so that you have more time to look at it. I'll create more scenarios. So for now, team, members of the academy, see you tomorrow. I'll be starting off from dollar today, around 15, I think. I hope so. And I pray that I arrive safely. The road is quite bad. And you won't see any bad news on me. Thank you so much, and bye-bye.
Tomorrow, what did you say time? What time?
I think around 14, so that in the morning I can rest a bit.
Nah, that's okay.
So, thank you.
All right, travel safely, coach.
Thank you. Thanks so much, Muka. Thanks, Tim. Thanks, Luke.